Good afternoon, everyone. Good to see you here. Thank you for coming. For those of you who have seen me before, I'll tell you that, I don't need to remind you, I have a conversational style. So I'm not going to be talking at you so much as we're going to put up something and it's open for discussion when it's up there. If you have a question, throw up a hand or shout out and we'll deal with it as we go. We are a research business, so we sell insight. And we build that insight by doing homework, by digging for data, by doing big data analysis. A lot of the things you're going to see here, you literally cannot get anywhere else. And our customer base is mostly the larger corporations. So the operating miners, the middle bracket miners who are looking to figure out whether they should buy something or grassroots. We have that kind of data. And our portfolio of what we study is continually growing. So for those of you who saw me pre-pandemic, since then we've added silver, critical metals, and Patricia's here, and a few other things. So we'll get underway. So if you want to reach out to us, our salesman is here, Tom, in the front row. Our engine of intelligence is Chantel, right here in the front row. Patricia, who's worked for Scotiabank for a very long time, knows more about the clean energy metals than anybody. If you need me, I'm Brian at capitalightresearch.com. We're also at booth 902, and at any time you can go to our website, capitalightresearch.com, sign up for a free trial, see all of our work, but we are a paid service, and we're worth every penny of it. Here's our agenda. We're going to talk about what we do and who we are. We're going to talk about setting some history for the long-term cycles. What are they? Why do they exist? Then we're going to look at the one that's happening next, which has already started. Then we're going to talk about commodity equities. And let's keep in mind, we don't do stock picks. We think, as you'll learn in a minute, if you don't get the commodity right, which stock amongst the ones that you pick is less important than getting the commodity right. If you pick the best gold stock, but the price of gold falls 30, 40% over the time you hold that stock, you're still not going to win. So we're selling that kind of information based on everything we see. And as a treat at the end, we're going to share with you our 3-year forecasts for a selection of the metals. Some of the work we do is weekly. For example, every Friday night, Vancouver time, we publish the Muir & Gold Monitor. Some of the work we do is monthly. And then others are several times throughout the week. For example, our technical analysis service, which is broad across the economy. It's not necessarily a metals and mining thing. They put out ideas as they find them. And if that means in 1 week they put out 6 and the next week they put out 1, that's just the way it goes. Okay? And as a reminder, everything we do is subscription only. And we do that because there's no conflict between any banking or we're not trying to sell you anything except the subscription. All right, here's our team. Patricia, who I've already introduced, invented or developed the Scotiabank Commodity Price Index. Dr. Tom Brady, who writes our silver research, was the chief economist at Newmont and has a PhD in mineral economics from the Colorado School of Mines. Dr. Martin Muirenbeeld has been the authority on gold price forecasts for the last 40 years, so much so that one of his customers, Dundee, bought his business in 2004. And Ron Meisels, who does our technical analysis, has been doing it for 40 years and is the leader in Canada in it, bar none. So that's our team. These are not MBA students fresh out of school learning as they try to tell you what they think they know. This is the gray power, and it's worth every penny. Our chart here, we have vertically coded the bull markets and the bear markets in commodity prices, and we've taken the data back all the way to the year 1900, and we've set the commodity price in real terms, so this is after you take out the inflation, to 100. So from there, you can see there are periods where, for the most part, they all move together, and in the blue periods, which are titled U.S. industrialization in the 1910s, rearmament prior to World War II in the 1940s, reindustrialization of Europe and Japan in the 60s to 70s, the emergence of the BRICS, which is a reindustrialization, I guess, of Russia, China, Brazil, India, And then a short bear where everything fell in price from, we'll call it 2011 to 2017 or 2020. And that has started us now in the new blue section, which we're calling global transformation. And the question marks there are because we don't know how long it will run. But we do know that it has started, and we also know it's going to be powerful. And you can see some of the reasoning for that here. Remember, this is backed out of inflation. So we're not tracking price, we're tracking purchasing power required to buy the commodity. And for one of the very first times on that chart, in fact, the first time, the blue section, the bull market, is starting at higher prices than ever before. And let's ask why. And of course, that can be a 10,000 word essay, but I'll give it to you in 2 points right now. One, no one expected this EV and industrial transition to happen as quickly as it did. And second, the world is really, you can't build a mine, I guess is the short answer. In the 1910s, you can build a mine just by getting your hands on the land and getting started. In the 1940s, government permitting. 1970s, easy to expand something that's already existing, and you can build something in the hinterland. Now, what can you build in North America, and how long will it take? So that kind of supply response and supply constraint is why the bear market that we've just come through is so short, and the bull market that we're starting now is starting from a higher real price than ever. Gold versus stocks, are we crazy? And I'm not asking about we in this room, but if you watch CNBC or you talk to your brother-in-law and you tell them that you're interested in gold, they'll call you crazy, because don't you know that stocks are better for the long run? Don't you know that Apple is the best company and you should own that? Don't you know that dividends matter? So as a mental exercise, what we've done here on this chart is when gold started to trade freely, we'll call that 1970, we've done a really short index here that says if the S&P and gold were the same price level, we're ignoring dividends for a minute here, just to make the math simpler. In 1970, we ran it all the way to today. They're exactly the same. Does that surprise anyone? It does. Will you remember that the next time someone tells you you're crazy for going to the VRIC conference? You won't remember? Okay. Take a picture of that, because it's true. Okay, and obviously there are gaps you can see from 1970 all the way to about 1995 on here. Gold was actually ahead. And then from 95 through 2006, stocks got ahead. Gold's been ahead for the last little while, and it looks like stocks are catching up. And keep also in mind that dividends will matter to this calculation and starting price and everything else. But here's a 50-year stretch, and the point I want you to take away from this is that they're the same order of magnitude in result. Okay? There was a hand in the back. So, not including dividends, because of course gold doesn't pay dividends, and there's no way to do a dividend except to chip off a little bit and sell it each time. So, all I want you to see here is that it's not as crazy as you think, because they're at the same order of magnitude. Now, if the dividends make it, let's call it 50% better when you compound all the way through, sure, but that would still be a surprise result to most people. Okay? All right, here's a data section. I'm already halfway through my time. We're gonna run over. Anybody okay with that? All right. So this is just showing some of the more recent rallies of different time periods, and if you need this, get in touch with us, we'll send it to you, okay? But certainly since the start of the Ukraine war, and by the way, commodity prices love wars. The question is why? First is, the government becomes the first buyer of commodity price, so it's hard to trade freely. You can't get commodities from places you would have otherwise gotten them before, countries, suppliers, everything else like that. But more importantly, peace is expensive, war is expensive, and that printing that eventually pays for these things is what pushes up the nominal price in order to keep that first chart we showed you, the long-term cycle price, in real terms, the same. All right, why is there a new cycle starting? In addition to, well, the longer reason is we're going to have 25% more people on the planet in 28 years than we have now. And a lot of that 25% more people are going to be consuming things and living in places that need more materials in order to get built. So we'll go through in a minute here how, on a per capita basis, a city is far more copper and nickel intensive to get built than a farm is. And people are, first of all, there's going to be more of them. They're going to be moving into cities, and we're going to show you the growth of that cities, the growth of those cities. Any questions on this? And interesting here, we're using Nigeria, which in 2010 had roughly half the population of the US, but by 2050, it'll have 10% more. So that gives you a clue as to where that population growth is happening. Left-hand side, current dense cities. Right-hand side, 2030 dense cities, and we've circled where most of the growth is happening. And you can see it's in Africa, it's in India. You expected it already in China, but what we're trying to show you here is you're not expecting the India and Africa growth, okay? Cities use more copper, and we're just picking on copper here for a minute, per capita than farms do. The current urbanization in China is 60%, but in India it's only 30%, and it's going to go to 45 over the next 30 years. And so all of these trends are forcing more demand. Okay. The move away from oil has already started, and what I've got here in the headline is I want you to see that the forecasted demand for oil products in 2050 is exactly equal to the 2020 demand. So although we're going to move higher, the rate of growth has turned negative or is about to turn negative, and in 2050 we'll need no more oil than we need now, even despite the 25% growth in population, and that difference in intensity is going to be made up by the metals. Okay, any questions on that? Okay. What you've all seen this one. We've got our own version of it. What's in a Tesla and what does it mean for markets? For those in the back, this is all hard to read, and I know the left side's been cut off a bit. And of course, every company here is making these arguments to you. If you need to cross-check those arguments, that's what goes into our commodity price forecasts, which we'll share at the bottom of the deck here, okay? Here is a complex chart showing the lithium supply chain. And as I mentioned, Patricia Moore is in the audience, and she's suggesting, and she's right, that Canada should be focusing on that middle bracket. Along the bottom, there's 3 brackets. So the middle bracket says that 60% of lithium conversion processing occurs in China, and that's where she sees Canada has the biggest opportunity to make gains in this economic landscape. Okay? Here's our point. We don't pick the stocks. You're going to pick your own stocks anyway. We're trying to make sure that you're picking them with a solid understanding of what the commodity price is going to do while you own it. It's one of my favorite charts. So for those of you who are too young, if we start on the left-hand side, 1984 to 2008, you will see what we've drawn as a straight upward sloping gold line, and it's kind of the average of all this squiggly blue line from 1984 to 2008. Rest his soul, bless him, love him. That's what I call the Peter Monk line. And what we mean by that, the old guys will get it. If you had a gold mine and you sold forward your production to get cash and you used that cash to buy another gold mine, you increased your ounces on the balance sheet, you told the world you were a growth stock and your stock price went up. Lots of nodding heads. Okay. But then from 2008 onwards, that reversed itself because now the money wasn't available after the crisis, and you had to put those ounces into production, and everybody discovered there was no money left over for the shareholders after you took the write-offs on the bad buys that you made. And that's what pushed all the valuations for the industry down, and that ended in 2016. Since then, we've got an almost flat but slightly rising line that we're calling the current 2016 onwards trend, and we think that will accelerate as this commodity moves along. So a lot of stuff in here. I'll stop for questions. Yes? Okay, we'll get to our gold price. I'm going to run over. Sorry, guys. We'll get to our gold price in the last couple of slides. and we'll tackle that then. Plus, you can talk to me on the side. Okay? All right. Any accountants in the room? Anybody know the difference between economic value and accounting profit? Economic value says that your entire balance sheet you could conceptually think of as, I could sell everything on the balance sheet to cash one day and put it in bonds, and the rate I get on the bonds is really what I should have as my hurdle rate for conducting any business at all. I got some nodding. Okay. So what we've done here is we've taken that concept and we've applied it to the difference between the price of gold and the all-in sustaining cost line of the industry producing gold. And what you're really trying to get at here is if we took all the fixed costs that went into buying and building the mine and treated that as if it was a pile of T-bills earning the risk-free rate, what's my margin? And so what you can see here is we've highlighted the periods where the margin really expands. And that's when you really want to be in these names the most. And when the margin falls back into where the blue line and the gold line are roughly together or in the pink zone, then they're just commodity businesses. But right now they're cash flow generating businesses that are really sexy. Some of these things could buy themselves back and go private in a handful of years if left alone. Any questions on that? Okay. Somewhat related, we use a price to book, EV over EBITDA, and then risk-free rate equation with a whole bunch of other things you don't see here. And we statistically take that all the way back to all the data we have, and then we color it when it's at the top of the range is expensive, that's red. White, that's most of the time. Green is when they're cheap on their historical basis, on a cash flow basis. We call this our Neapolitan chart. In our economics work, we do this for every sub-index in the TSX. We do it for every sub-index in the S&P 500. People love these, and gold stocks are still cheap. Doesn't matter if they've run up from 2016, they're still cheap compared to their fundamentals. Any questions? Okay, if you're a long-term investor, you buy in the green and you hold until the red. Okay? All right. This one is a personal favorite of mine. 2017, myself and Martin Murenbild, we flew to Zurich. We gave a presentation to a conference like this, and we were sponsored by Agnico Eagle and Osisko. After the presentation, we were standing around having beers with Sean Boyd, big moment for me, and we were talking about the cycle because we were making the argument that the bear market and the bear cycle in commodities had just ended. It was 2017, it was probably too early to tell, but we started talking about the future, and I said to Sean Boyd, how do you know when the cycle is starting to end? And his answer was, by the time by the way, Sean Boyd is the CEO of Agnico, right? Everybody know that? Okay. By the time I'm getting invited to meet equity holders in Manhattan who don't know me and I don't know them, it's usually 2 or 3 years to the top of the cycle from there. So what he's saying is by the time the generalists show up and start buying the stock, you're most of the way through the cycle. I said to him, the current bear market has been so long and so horrible, maybe that'll run for 5 years, not 2. And he said, there's no way to tell. And I said, we're going to build you something to tell. So here's what we built. It's a big data study. It goes back to the year 2000. And we are measuring how easy it is or difficult it is for a hypothetical junior to raise money and go drilling. If you can't raise money, you're not at the top of the cycle. And if 2 iguanas with a spreadsheet can raise $6 million and go drill for Madagascar, go drill for tin in Madagascar, maybe you're at the top of the cycle. So what we've done here is built an oscillator that reflects that data. And I know we're on the right track because I got a complaint from Pierre Lassonde about the 2016 bottom. That's the hardest it's ever been in his career. And so I know we're on the right track. People are looking and they're finding less. We're tracking how people are coming back into the sector, and that's how we do that with our generalist investor trackers. There's our forecasts. I'll leave them on the screen. Come talk to us afterwards.